US inflation is in line with forecasts and markets now see a Fed rate cut next week as a near certainty. Japanese producer prices rise at their fastest rate in 16 months. Soft New Zealand data points to a triple-dip recession this year, and Australian jobs growth is expected to keep the RBA on its toes. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ commodity strategist Soni Kumari says the global aluminium market faces a number of challenges next year.
The most unknown factor in 2025 is going to be trade tariffs by the US, and we don't have much idea what would be the real import tariff on different products.
But first, in 5 and 5 with ANZ. US stocks are up another 1% this morning and bond yields have fallen a couple of basis points after US CPI inflation data for November showed inflation slowing down enough for the Fed to cut another 25 basis points next week. ANZ head of G3 Economics, Brian Martin, says the 0.3% rises in both headline and core inflation reassured markets about the rate cut, which is now 96.5% priced in by traders.
The FOMC would be encouraged that the disinflationary process is in place. That will allow them to cut interest rates, although we do expect that next year they are going to slow that pace of cutting down. Our view is that the FOMC will move to intermittent rate cuts, i.e. skipping at every alternate meeting. And really what it wants to do now is, having cut, it wants to assess the landscape, see what the policies of the incoming Trump administration will be.
The US dollar index was flat as of 4 a.m. Sydney-Melbourne time. The Aussie dollar was also flat at 63.77 US cents, and the Kiwi dollar was down 0.1% at 57.95 US cents. Number 2, the Reserve Bank of Australia will be closely watching the final set of Australian jobs market figures for the year today after softening its stance on inflation this week. ANZ Head of Australian Economics, Adam Boyton, is expecting ongoing jobs growth of 25,000 in November and for the unemployment rate to stay relatively tight at 4.1%.
I think in the wake of this week's communication from the RBA and the post-meeting statement on Tuesday, it certainly appears highly likely we'll get an interest rate cut in the first half of next year. Picking the month for these things is always difficult, but if we were to get an increase in the unemployment rate to say 4.3 or above and a fall in employment, that would take some of the gloss off what to date has been a reasonably resilient labour market story in Australia.
Number 3, the prices paid by Japanese firms for their goods imports rose at the fastest pace in 16 months in November, as measured by the PPI, which rose 3.7% from a year ago. ANZ FX analyst Felix Ryan says that supports the Bank of Japan's desire for inflation, but it will be wanting to see similar pressures on the services side of the economy.
Nonetheless, the increase in goods PPI is supportive of the broader build in inflationary pressures within Japan and definitely does agree with our view of further policy tightening by the Bank of Japan coming up in future meetings. So the main point, though, data-wise, will be the TANCAN survey for Q4 coming out at 10:50 a.m. Sydney time this Friday. So that'll definitely be the major focus for the Bank of Japan going into next week's meeting. But nonetheless, this stronger result in goods PPI is definitely helpful in terms of further policy tightening from here.
Number 4, New Zealand traffic movements through November indicate the soft activity in Q3 might be passing into the final quarter of the year. According to ANZ's Trachometer measure, the light traffic measure, which has a 6-month lead on demand, was flat in November, while the heavy traffic index, which is linked to real-time production GDP, dropped 2.5%. Here's ANZ New Zealand Chief Economist Sharon Zollner.
It can be volatile month to month though, and if you step back and look at what's happened over the year, actually heavy traffic is up a bit more than 1%, whereas the light traffic has actually been pretty flat, which is surprising given the population growth that we have. Perhaps it's representative of the fact that people are being a little bit careful with their spending at the moment, probably including unnecessary trips away.
Number 5. Another soft data print for New Zealand yesterday was Q3 manufacturing activity, the final partial indicator for next week's GDP. The volume of total manufacturing sales fell 1.2% in the quarter after a small rise in June. ANZ economist Henry Russell says high wholesale electricity prices led to business closures and production limits in the quarter.
Overall, what this means for our expectation for next week's Q3 GDP figures, now with all the partial indicators in, we are seeing a little bit of downside risk to our current published forecast, which was for the economy to contract 0.2% quarter on quarter. Now, that would mark another technical recession for New Zealand after last quarter's contraction too. But hopefully this will be the last now that interest rates have fallen significantly and we're seeing the signs that the economy is responding to lower interest rates. Our expectation is that a gradual recovery will follow and start to accelerate into 2025.
Henry Russell there. Now, in our bonus deep dive interview, ANZ commodity strategist Soni Kumari says the global aluminium market faces a range of demand and supply issues in 2025.
Aluminium market has been facing both supply and demand side challenges, which is likely to continue in 2025 as well, but with a different intensity. So aluminium is facing supply challenges for raw materials, which is likely to sustain in the short term. Short term means in early 2025, this is likely to be common, and that will push raw material prices higher, and that will have impact on production cost for smelters. The other challenge, which is likely to, be prominent next year, would be China's production cap of 45 million tons, which is likely to slow down overall aluminum production growth and going forward from 2025 onwards. On the demand side, the US import tariff will be a key factor which will be injecting, a lot of uncertainty in the market. So import tariffs are likely to slow down capital spending in key markets, and which will have impact on aluminum demand in 2025.
And what about the trade policies, both the Trump ones and other ones?
The most unknown factor in 2025, it's going to be trade tariffs by the US. And we don't have much idea what would be the real import tariff on different products. But so far, what President-elect Trump has proposed a 25% import tariff on Mexico and Canada, and additional 10% on Chinese products. So just to give a fair bit of idea, US imports 90% of aluminum for its demand, and 60% to 70% of the import that comes from Canada. So a 25% import tariff will have, direct impact on consumers, because they have to bear 25% of price rise, and that will keep US spot premium higher. So right now it's nearly $450 to $480 per ton. This is likely to increase to $600 per ton.
Can you tell us too about the supply issues, particularly around what's happening with the Guinea Alumina Corporation?
So just to give you a bit of idea around Guinea position as a supplier in aluminum market. So Guinea is a key supplier for bauxite, which is used for aluminum production. And in last 6-7 years, its production has increased many times. Now it produces nearly 30% of global output. And more importantly, China's reliance on Guinea's bauxite exports has increased to 70%. So it's such volume which getting disrupted, and that's why we are seeing prices for bauxite and aluminum hitting a record high. So if the suspension continues, I think prices for raw materials for aluminum, it's likely to stay elevated, and that will have impact on aluminum prices as well.
So just bringing it all together, what do you see as the demand-supply imbalance for next year, and what might that mean for prices?
Well, raw material supply tightness, it's likely to ease in 2025. The tightness is likely to sustain in early 2025 as well. We see aluminum supply growth, it's slowing down to 2.3%, largely because of China's production capacity caps to 45 million tons. So overall, we see global aluminum production to increase by 2.3%, while demand is likely to grow by nearly 3%. So that will keep market undersupplied, and that is likely to protect the aluminum downside to nearly 2,400 per ton in 2025.
Soni Kumari there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, December the 12th. Catch you tomorrow with what those Australian jobs figures might mean for the RBA. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.